Crowley. Welcome to another episode of Venture Capital Press's webinar series. This one's going to be on due diligence for mergers and acquisitions. So I'm going to assume that you're selling your business, but obviously it's not too hard to stretch to think about the same topics I'm going to cover from a buyer's perspective. So when we go to sell our business, there are different times when we're going to provide information to a potential buyer. Initially, when someone makes an offer to buy our business, they might ask us for financial statements. It's okay to give a buyer high-level financial statements with the understanding that they're to be kept confidential. When the buyer asks for more than very basic financial statements, they start asking for customer contracts, they want to look at your QuickBooks, they want to start interviewing people. That would be the time to get a confidentiality agreement or a non-disclosure agreement. They're basically the same thing with different words. We have other webinars talking about NDAs, non-disclosure agreements. So you're welcome to take a look at those. My assumption is that you're at the place where a buyer wants to see more than did you do $5 million worth of revenue last year or $2 million worth of revenue, and now they really want to get into the details. You've put in a non-disclosure agreement between the two of you. Both parties have actually signed it, and now we're ready for the buyer to learn more about your business. So in an acquisition, the buyer is thinking about, are the assets that they're looking to get, do those actually exist? Do you own them? Does anybody else have a right to them? And they're looking for risk to see whether the price that they're offering you is actually a fair price, or maybe it should be lower. So first, let's talk about that first category of, do the assets they think they're getting actually exist? So if you're a brick and mortar company where maybe you're manufacturing washing machines, the buyer is going to want to know, do you actually have inventory? Do you have parts to manufacture the washing machines? Do you own the equipment that you're using to actually do the manufacturing, or do you lease them from somebody? That means you don't actually own them. You have a right to continue using them, but those don't really count as assets of the company. So the buyer needs to know that. The buyer also needs to know the building that you're manufacturing those washing machines in. Is that a lease, or do you own the building? Because that's a very different issue. If they want to buy the stock of your business, they'd have to pay for the building too. Maybe they don't want that. So the buyer needs to understand those things. From a contract standpoint, contracts are assets too, and they're also liabilities. So if I'm buying your manufacturing business with washing machines, I want to know, who are your customers? Now, you may not want to tell me who your customers are, even with a non-disclosure agreement, especially if I'm one of your competitors. But I ought to be able to get a list of your top 20 customers without names. Maybe it's customer A, customer B, customer C. But I need to know, are 3 of your customers equal to 80% of your business? Are they equal to 20% of your business? There's different levels of risk, because if one of those customers that's worth 80% of your business goes away and they already don't like my company, the buyer, then I'm going to be very stressed about buying your business, and I may only be willing to send you money, the wire transfer, the check, when I've actually had a chance to talk to that customer and confirm that they really are going to honor that contract if I buy your company. So I will probably want to see copies of the contracts themselves. If you want to keep the customer names confidential, you can always use whiteout, redact the names. You might even redact some of the pricing initially, but I'm going to want to know, how much are you paying for parts? How much are you charging your customers? What's your profit margin? All those good things. So when you get ready to sell your company, it would be best if we don't wait until the last minute when we have an actual offer in writing, but if we organize those things when we think that we're getting ready to sell. So if I'm making this video in 2018, if I think that I would like to sell my business by the end of the year, January, February would be an awfully good time to organize all of my contracts, make sure that pages aren't missing, that we don't have contracts that expired and we're still doing business, but we need to amend them to get them up to date, that I'm not missing signatures. That would be embarrassing. Getting organized and thinking as if you're the buyer of your company before you go out to market will make the diligence so much easier. And it could also help the purchase price. If a buyer thinks that you're disorganized, you can't even find your own customer contracts, I don't know that they're going to want to pay 5 times your earnings. They might only want to pay 4 times because it looks disorganized and they may not be able to find everything that they need. So more organized equals potentially higher price. We also, when we're involved on what I call defensive due diligence, where someone's asking me for materials as the seller, I want to make sure that I'm disclosing everything that I need to disclose. Disclosure is actually your friend, because what we don't want to have happen is a situation where we as the seller get cute and we know that there's a lawsuit and the buyer hasn't found it. They're going to draft their purchase agreement in a way that if they discover horrible surprises after the deal is done, they're going to come back and they're going to sue us for that. Or they're going to insist on, we don't really get the sense from talking to you that you're telling us everything. So instead of paying you 100% of the purchase price at the closing, we better pay you 50%, and we'll put the other 50% in an escrow that you'll get a year from now if no nasty surprises come falling out of the closet. So you could hurt yourself by being too cute and too guarded when people are asking you questions. Obviously, you don't want to overemphasize things that are negative, but you also don't want to hide them either. So if we're back at that washing machine plant and we were using chemicals and Bob, the supervisor, spilled some chemicals in the back of the plant and we didn't fix it, we should probably at least tell the buyer that we do know of a potential environmental issue. We had a chemical spill, we don't know how serious it is, but if you buy the business, you're going to have to deal with it. So better to be upfront on those things. And then the same thing is also true with financial information. When we did the webinar on due diligence for startups that were looking for venture capital investments, we talked a little bit about this. But the buyer's going to be interested in knowing about your assets and your liabilities. They're also going to want to see what your revenue and expenses were like, probably not for the last month, but at least for the last year, maybe a couple of years. And you may think, gosh, that's awfully grabby. Well, the reason that the buyer wants to see financial statements for multiple years is they want to see whether there's a trend. So if in 2015 I had 10 million worth of revenue, 2016 I had 5 million worth of revenue, this year I had 1 million worth of revenue, that sounds like a pretty bad trend. And so the buyer may not want to pay 5 times your revenue. They may only want to pay 2 times your revenue, because next year could be even worse than this year. So they're going to ask for those things. To the extent that there's a story to tell, our manufacturing operation was in Florida and there was a horrible hurricane. That's a story to tell and explain why those numbers are that way. But you should expect that the buyer is going to want multiple years of information. Same reason they're going to ask for multiple years of tax returns. You might have a year where you showed a big loss and you didn't pay any taxes, but the year before that you paid a ton of tax. Well, depending on what the outcome is, that may change the buyer's equation on what they're thinking about. Understand that when a buyer makes you a written offer for a $10 million purchase price, that's probably the highest price you are ever going to get. The buyer, when they're doing diligence, 1, they want to understand your business, but 2, they are also looking for reasons to pay you a little less. So we don't want to overemphasize negative stories, but we don't want to hide them either. So I know that sounds like a little bit of a catch-22, but the more honest you are, the better off you're going to do after the deal. Other things to think about, the buyer will be interested in interviewing your customers. Usually that comes close to the end of a deal. So when the purchase agreement is largely negotiated, We know that the price isn't moving. We've got consulting agreements with employees that are going to be leaving. We've got all the secondary documents drafted. That would be the time that you allow a buyer to meet some of your employees. Maybe not all of them, but certainly the critical ones that if they left, it would damage the buyer. Usually you call those key employees. But you wouldn't want them to interview them at the very start of the deal, because maybe the employees, 3 of them are really important, and the rest of the business, if it's a service business like a law firm or a consulting business, maybe I could just hire those 3 really good people and not buy the other 50 employees in your lease and all of your contracts, and it would be a lot cheaper for me. So we want to be very careful during due diligence who we introduce to the buyer, and try to keep our team narrow, but at the same time give the buyer what they need so that they're willing to write us that check at the end of the deal. So quite a bit to think about. You would be very wise to make sure that you have an accountant on board to help translate the financial information and provide it in a normal format that the buyer is expecting. You should probably have lawyers next to you during the due diligence phase, so they can make sure that you're disclosing the right stuff in the right way at the right time, in a way that's going to benefit you. If you've got a brick and mortar business and you have something funky like you're a chemical plant, you're probably going to want to have an environmental consultant to help you think through issues that might be coming up there. And you should at least open the curtain to your human resources people. So if you have an HR manager, don't keep them in the dark until the very end of the deal. You want to make sure that they know what's going on, so then they can help think about the transition after the deal on how our employees are going to move to the buyer's 401k plan and the health and the dental and the vision, all of those good things. So those are things that you should be expecting to do. These days, you would provide what's called a virtual due diligence room. So you would load up most of your documents onto a cloud server. Obviously, it should be secure, but you should have the ability to invite and turn off invites for the buyer's troops. And you also would like to have a cloud server that allows you to see what activities is going on in the data room on the cloud server. So what does that mean? So if the buyer says, load up all of your documents, and you load them up and you go in and you look to see activity, and there's been no activity for the last 3 weeks, that looks like the buyer isn't very serious. If instead you see a ton of people from the law firm of Dewey, Cheatham, and Howe, the lawyers for the buyer, going into the diligence room and they're looking at every single contract, you can feel pretty secure that this is a buyer that's real. They're spending a lot of money on the lawyers are doing things, so that feels like a pretty good buyer. This is important to think about in the context of an auction. So if you only have one buyer, it is what it is, but if you have 4 different buyers and their bids are all about the same, the one who's more active might be the buyer that's most likely to give you a higher price if you push them a little, and we might like that buyer better. So those are good things for you to think about if you're in the process of trying to sell your business. We hope it's been educational, and we hope you enjoy our other videos. Thank you.